All right, let's finish this up. So we're going to talk about errors in a second, right? What happens if there's a mistake? Now, every business has inventory, has to perform a physical count of that inventory at least once a year. Okay, usually done at year end. Well, always done at year end. Depending on what your year end is, right? If you're a fiscal year company, it could be any point during the year, but a calendar year company is going to count somewhere around December 31st. And inevitably there's going to be mistakes, right? The problem is if there's a significant mistake, material mistake, if you remember from the last one, if it's a material mistake, you've got to restate your financial statements. If it's not a material mistake, maybe don't restate anything. But what happens in general when there's an error? Well, one error, unfortunately, carries along like a cascade of effects. Because if you miscount inventory, remember, inventory is only one of two places. It's either sitting on your shelf or it's sold. So if you miscount what's on your shelf, now you're going to mess up the cost of goods sold number too. And that's going to mess up gross profit. And then that's going to mess up net income. All right, so you see how this cascades? All right, before we start talking about that, though, I want to talk about this cost of goods sold section, because everything I've shown you has just been sales revenue minus cost of goods sold gives you gross profit. Well, there's a lot going on here we haven't talked about. And I want to explain to you what you see going on in here. You've got beginning inventory plus the purchases, gives me cost of goods available for sale, minus the ending inventory, and that gives me gross cost of goods sold. Well, that's a lot more than what I've been saying, right? So let me kind of illustrate for you how that works. So the format, let's say that I don't have candy bars. I only had animal crackers. So we're going to go with animal crackers. My children ate all of my candy bars. So let's say, I'm illustrating this with animals. Let's say I've got 4 animal crackers, right? And that's not nearly enough. I'm still going to be hungry. I decide I'm going to buy some more. So I'm starting off with 4 animal crackers. And I decide I'm going to buy another 6 of them. Right? So I'm buying another 6 animal crackers. So I had the 4 and I'm buying another 6. In general, now I've got 10 available to me, right? 10 available to do with as I please. Now I don't count how many animal crackers I'm eating. Maybe I'm, I had a long night. I ate a bunch of the animal crackers and I look in the morning. In the morning, I've only got 2 left. So if that's the case and I had 10, and I have 2 left in my inventory, I must have eaten the other 8, right? Well, that's exactly what's going on here. So, my beginning inventory was the 4 that I started with. I bought another 6, so I had 10 available to me, right? That's my total, all of my inventory all together, everything I have. And then I subtract what do I have left? Basically, what's still sitting on my shelves. Because if I subtract whatever's left, if I had 10 in total, and I subtract the 2 that I have left that are on my shelves, or, my hand, the 2, then I must have sold or eaten the other 8 of them. That's the cost of goods that I sold. Okay, so I hope that little animal cracker illustration helped. Here, puppy. There you go. He's been all over me he always gets 1. All right. So let's look at this example. It says, assume the ending inventory was accidentally overstated by $1,800. Well, what does that do? Well, if ending inventory is overstated by $1,800, think about it. It's a balance, right? If ending inventory is overstated by $1,800, meaning you're saying you have more than you do, that means your cost of goods sold is understated because inventory is only one of 2 places. So if one goes up, the other's got to go down. So if cost of goods sold is understated, that means your expenses are too low. It means your profit is recorded too high because you're not recording enough expenses. All right, you see how it's a cascade of effects here. And feel free to use your hands when you're trying to figure these things out. All right, so with the error, it was $58,000 minus $32,700 of cost of goods sold. If you were to correct it, it'd be $58,000 and the cost of goods sold, instead of you'd adjust it by the $1,800. It's $1,800. Okay, so if I were to fix it, it's $1,800. Ending inventory was too high. Cost of goods sold was too low. So I'd make cost of goods sold a higher number. If I was fixing it, right, bring inventory down, bring cost of goods sold, make it a bigger number, and it'd be $34,500. And your gross profit should be $23,500. All right. Requirement 2 says, what if the error was not caught? What if there was a mistake? Well, if there was an error, asterisk me. If there was an error not caught, it would fix itself the next year. If you were overstated one year, you'd be understated the next year if you counted it accurately. Okay, this is going to be a quiz question. Sit. This is Astro. See the little face? Good boy. I'll make sure that's in the quiz. All right, so let's move along. Internal controls. Internal controls of inventory. Ensure that inventory is not purchased without proper authorization. Imagine inventory is one of those things that get stolen, right? A lot. So we should track it. We have to purchase it properly. It's got to go through a bunch of channels. This is called internal controls. Internal controls are the systems that you put into place to safeguard your assets, prevent things like theft and destruction. So a typical internal control for inventory, we're going to show you right here, is a purchase order. A purchase order is going to have to be signed off on and approved by, usually their signatures. You can't just buy something in a business, right? You have to have a purchase order that has all the appropriate approval signatures. That purchase order then goes, there, at the top of the description, the quantity, the price, right, and the freight terms. That goes to the vendor. The vendor then sends the materials. The materials go to receiving, right? There's usually a receiving bay where all the inventory goes. And that receiving person gets a report and they say, yes, we did in fact receive 100 pairs of, or 100 animal crackers. And the vendor will send an invoice. All three of these pieces have to match before the bill gets paid by the company, right? And the idea is that it's to prevent people from stealing your items or purchasing things on your account and so on. So you have to have a three-way match between all of these. The invoice should match the receiving report, matches purchase order, and once all three of those things match, the bill will get paid. If there's a discrepancy, that's when you find the problems. All right. I mentioned physical inventory should get done at least once a year. We talked about that with shrinkage, actually at the end of chapter 5, right? We debit cost of goods sold and credit inventory for the difference between the two, between your physical count and what is actually on your records. And physical safeguards should be put into place to prevent theft and damage of inventory, right? Cameras, locks, security, ID tags, controls, ambient controls, meaning like if it's perishable, right? You want to make sure that the controls are in place. So those are really your major things with inventory, internal controls of inventory, is making sure they're purchased, safeguarded properly, both in the purchase and in the actual keeping of the inventory itself. All right, that's it for this chapter.